Okay, so that was the first part. And remember, this problem had 2 months in it. So now the same thing, the kind of the same things that we did in October, we're going to see that we're going to do in November. And we're going to start November with all the stuff that goes on. So when we look at November, notice we've got more transactions, and they're already noted for us here on the spreadsheet. We actually have things that go all the way to November the 30th, okay, of the things that are being done. So he's starting his business. He's getting his equipment. Now he's going to hopefully make some money. Who knows? So, 4, November the 1st. Here we go. Catered to graduation and immediately collected cash for $1,300. Catered to graduation, probably party or something, but immediately got the cash, not the crash, but got the cash. So, which 2 counts are impacted? The revenue and the cash, yes. So, we're going to debit what first? We're going to debit the cash first, right? Because we're getting the money. So it's $1,300. Either way, we're going to put the money into the accounts. Then we're going to go ahead and put the money in also into the catering revenue. He made money. Okay? Actually, he made money enough to go ahead and pay off that accounts payable if he chooses to. Okay? So we bring your balances down. And remember, the reason I say bring your balances down is so that you know which transactions you've actually been dealing with for that first day in November. Then he goes ahead and he's now going to pay the salaries of employees. Oops. At least he made enough money for that. So paid the salaries of employees. So what 2 accounts are being impacted? Expenses, good, and cash, because he paid them. It doesn't say that he put them on account or paying them next month or anything. He's going to pay them out. So you're going to debit your expenses for how much money? $800. And then you're going to debit or decrease cash by how much? $800. All the others are not impacted, right? And then you bring your balances down. Now, in expenses, you're recording how much expenses you had for the month. And guess what? At the end of the year, you're going to show how much you had as far as expenses for wages as well. Because it's important. Because at the end of the year, you have to tell your people how much they earned. Because something comes up in April, which is what? Income tax. How much they still owe the government, or how much the government owes them. Oh, and by the way, apparently, the federal government says that they will be issuing out refunds if you have a refund coming towards you in April for the IRS, for any employment. So we bring our balances down. Now that happened on the 5th. Now on the 8th, see what he did on the 8th. Prepared desserts for customers on account. Okay? Prepare desserts. He made something for somebody else. So he did not collect the money right there and then. Now, how do I know that it's not something that he owes? Because it says prepared. He prepared the desserts. He is a catering company. So he then is going to do what? Accounts receivable, and which one? Which other one? Which other account? Yes, catering revenue. Very good. Because even though he didn't get paid yet, he still has to record how much money he made. So he's got the $800. No, how much was it? 500. Those are expensive desserts. So accounts receivable, money owed to him, and the revenue. So again, we go ahead and we bring everything down, our balances down, because there's a 0 here, 500 here. We bring our balances down so that we know exactly what is going on. Okay? Now on November the 10th, 2 days later, he received partial payment of $250 for November the 8th transaction. Well, let's go back. What happened on November the 8th? He has accounts receivable. He prepared the desserts, remember? So now he's getting partial payment. So we are going to debit what first? Which two accounts? The receivable. You were right the first time, Daryl. Okay, the receivable and which other one? Cash, because he got partial payment. So we're going to debit cash. We're going to increase cash of how much? $200, $250. I'm sorry, but I'm in debit and credit mode, even though we're going to get into it next week. And we're doing what now here for accounts receivable? Subtracting. Yes, we're decreasing it. So now, when we bring our balances over, how much money do we have now? $70,550. How much does that person owe us that we gave the desserts to? $250. We still have money that they owe us. All the other balances remain the same. Now, on November the 15th, it says that he paid the telephone bill. What two accounts? Expenses and cash. Correct. So we're going to debit our expenses first. So we're going to come over and we're going to debit our expenses. For how much? He's better be paying him something else if his cell phone bill for $400. My gosh. What else does he have? I pay less than that for 4 accounts. So he needs to get a new carrier. That's what I would do. Anyway, so $400. So we debit the expenses and we do what? We take the money out of cash or we credit cash, decreasing the amount of money that we have in cash by how much? $400. And we bring our balances down. Now this is interesting for the 17th. Listen to what it says. So, he decided that he was going to pay his home electric bill from the company's checkbook. Which two accounts? Withdraw and company's checkbook. Cash, correct. I know that most of us don't have a checkbook. We have a debit card. So just consider the checkbook as a debit card. Okay? So it would be the withdrawal. Okay? Because again, nothing happens to our cash account at all. So it would be the fact that we are going to have now on our withdrawal of how much? $160.